Good evening, all, and let's begin the today's session. The last session we were discussing about what is the financial statements and who are the people who are using the accounting data or financial statement. Now, let's talk about the fundamental things of accounts, that is, accounting concepts and accounting conventions. So, anybody know what is the difference between concepts and convention?
Sir, concepts are like the fixed rules and conventions can be are like we can change, we can do some additions and subtractions in them.
Thank you. It was a great to hear the response. So, as rightly point out, the accounting concepts are the fundamental rules, are the fundamental decisions what we are following or what we are observing. In accounting concepts, we are trying to define the rules which are very crucial, very essential, I should follow. Whereas accounting conventions are desired outlines which I need to observe for. So let's begin with one by one the each concepts and conventions. After conception conventions, even though you are knowing these things, I need to revise because it's a part of your financial reporting syllabus. My dear students, sometimes we feel that things are reported, things are repeated. But even though things are repeated, they are very crucial. We cannot just ignore their importance in accounting. So let's continue. Accounting concept. So concepts here are the postulates. The postulates means they are the essential conditions, which is a basic benchmark or I can say assumption on which the foundation of account works. So I can say that the accounting concepts are the benchmarks or the guidelines which a person need to observe if he want to complete his proper accounting in given format and without any errors. So for financial reporting, we need to understand accounting concepts and conventions. In your syllabus, they are not given concepts and conventions. They only disclose that I need to study about how the things are working. Let me share the syllabus so that it will be more clear to you. So this is the syllabus. In this syllabus, they are saying underlying assumptions where going concern, consistency, accrual, And then they talk about qualitative aspects of financial statement, where they talk about materiality, faithfulness, substantial over forms, neutrality, prudence, and completeness. So instead of taking halfway, we are going to study the accounting concepts and accounting conventions all. So the first concept is a business entity concept. Now, here the word can be divided into two parts. One, a business, and second is entity. So business means an organization. It can be a company, it can be a firm, it can be a society, it can be a small shop, or it can be any other type of organization where people are operating for earning something extra than their investments. Whereas the entity denotes an individual or a group of individuals who are working together. So, business entity concept denotes when I'm dealing with large scale people, I'm always talk about trademarks and seal. So, how a business is entity that is defined under this business entity concept. So, what is this concept? As per this concept, the business and owner they are two separate people. So, if I take example, suppose it's Thorat Pan Shop or Thorat Bookstore. So I as a person will be different and my business will be different. Now, whether my business will survive after me or not, that's a different question. But as per entity concept, each business and its owner, they are two separate people and counted as two different entities. When my business has a logo, it has a trade seal. Now, trade seal means the logo itself, or it has registered as a legal person under Companies Act. Either it has logo, trademark, legal seal, or a signing authority. Then, in such case, the business is continued after even the death of its owner because the business is passed to successor. Now, why this concept is essential? This concept gives an authority to business to make him the legal person who can stand in the court of law if he suffers any loss. For example, X enter into agreement with me and he just do a fraud. He take the books from my library and then tell the owner that I know Thorat sir, so I don't require to pay the fee. Whatever the book cost, it is free because I'm relative of Thorat sir. No, in a business, even the person is my relative, the person is of my knowledge, it is mentioned mandatory that if I withdraw from my business, then it's called personal income. If I put something in a business, then it's called personal investment. So when I withdraw from a business for my personal use, it is recognized as drawing. So withdrawing for personal use from the business is called drawing, whereas depositing money from personal account into business is called as a investment. So this separation will define how the person or proprietor and his business has relations. So in short, a business is a different and the owner is different. The books of accounts are prepared in the view of business and hence whatever the things a person gives to the business, for business it's a liability, and from business whatever the things he take out, it becomes a drawing. So, in short, suppose he gives capital, he gives loan, he gives his car, he gives anything to business, it becomes liability of business to repay the things to the person because owner is a proprietor. He cannot be considered himself as a business. Whereas when I take out from my business something, it is called as a drawings. For example, I have a factory of sugar and I take out suppose 200 kg of sugar for my personal work. Now, if I take it sugar in business, this is not called consumption. This is recognized as drawing. Whereas if I invest more 500 crores capital, it is called as investment and it is responsibility of the business to repay my money invested or to honor the interest or the liability along with my money for same. So, because of entity concept, we get a clear idea that if something is deposited, it becomes liability of business to repay, whereas if something is withdrawn from business, it becomes and drawings. The personal transactions and business transactions are need to be separated. I cannot just use the business property for personal use or personal property for business use. Now, those who are done with the taxation, there is a provision that if I use the office car for my personal purpose, it is recorded as taxable event. Whereas if I use the office car for office purpose only, then it is not recorded as my expenses because this is considered as business expenditure. So the transactions which are done favoring the owner is called drawings. The transaction which are done favoring the organizations is called investments. Now, the second example, if it's my own car and used for business purpose, then I will be reimbursed the running and maintenance cost, considering this as a donation or considering this a service to my business. So if I'm providing something my personal for a business, it's a become responsibility of that business to repay me. Whereas if I take out something from business, it will be drawings. So we covered the first concept, business entity concept. To just revise, as per the business entity concept, the person who is running the business and the business, they are two different people. The board of directors, the promoter, or the proprietor, they are considered as a different person and the business is different. If they withdraw something from business for personal use, it is recognized as drawing. If the proprietor, owner, or board of director, or somebody else deposit extra funds or provide something in assets or infrastructure, it is liability of business to repay that. So the first concept of accounting is entity concept, and this declares the business and the investors or business and the owners, they are two different peoples and they will always be differ in terms of their holdings. So this concept is giving clear fact understanding how the transactions related to the owner can be recorded. If the owner is withdrawing something, it's a drawing. Owner is adding something, it's a call as a investment. Now let's talk about second concept, going concept. Now, if we just understood here, it's go and ing. Normally, the word ing is used for past continuous tense. It means it was there, it will be there, and it is going to be there. So I am continue for a longer period, which is unlimited more in nature. So going concern is related to concept where I'm talking about the business is not closed. It just changed from one financial year to other financial year. But the nature of operations, the kind of activities, they are continuous in nature. So let's understand the going concern in detail. It is assumed that the owners they are different and business is different. The business until and unless meet with the sunk cost or the business where the financial viability of honoring the payments or operating the expenses becomes zero, till that a business can be continued. Only in case of solvency or by order of court or by legal compliances to any government law, the business is closed. It will not affect. If the three things are absent, then business can continue for a longer period. As per going concern, the every business is having indefinite period. For example, I complete year one, that is suppose from 1st of March, April to 31st March of 1 year, the transactions are closed and the balance is shifted to second year. Again in second year, the transaction settled, balance is shifted to third year. Again in third year, the same and so forth and so on. So it indicates my business is never closed. My business is never shut down. This shutdown is only happens in case of financial emergency or in case of personal disability to operate that entity as business. So till that time, my business is continued and it has a separate recognition than my owner. So the second concept, that is going concern, denotes that business has indefinite life and till the accounts or solvency of the business continued, there will be no issue for business. Similarly, the going concern is used as a tool to define the one more concept which is called as a period concept. We'll discuss this period concept. Now let's talk about the next concept, money measurement concept. So we are done with the two concepts. The first concept is entity, that is owner and the business. They are two different people. Second is going concern concept. And as per this concept, a business is a continuous activity. Unless it is decided or objectives are fulfilled, they cannot be closed. You can hand over the business from one to other generation, one person to other, but the level of production or activities they are continued till the financial viability is available. The third concept is money measurement concept. Now here again we have two words. The first word is money and second word is measurement. So these two combinedly indicates the third concept. As per money measurement concept, every transaction, every activity which is able to evaluate in money, in terms of money, that is recognized as money measurement concept. In terms of money measurement concept, it again gives an idea that if it's a barter exchange, if it is more than money, then how the transaction is compared or evaluated. So money will become the media. Now the beauty of this concept is it is again foundation of one more. This money measurement concept defines the period and defines the liability about all. As per this concept, the transaction which I do in barter, for example, I give 5 kg of rice and collect 1 liter of petrol. Then how the valuation will be done? There should be some common parameter. There should be some common base. The way I can evaluate and I can consider the cost. Because we know that if I'm valuing anything, the price is a very crucial concept. So this concept emphasizes that the account will record only those goods, those transactions which are in terms of money or they are able to value as money. For example, I just donated 1 crore rupees to a temple or 10 crore rupees to a school. So in that case, if I'm not receiving anything, if I'm not getting anything, then it's only a charitable work and no rewards. So this is not considered as gain, but even though it is not gain, money is there, it can be recorded. Suppose I donate my blood and take kidney from other person. Now here the cost which is paid is recorded based on the value which we are charged. But if there is no valuation, only the goods are exchanged, they are recorded if I can measure them in money. For example, I was going through the road and it was very heavy rain. Some person came and gave me an umbrella. Now in this transaction, he just given an umbrella to save myself from rain. After 10 minutes, he came to me and asked me to return the umbrella. So in this case, we are not done with the any transactions. He had just given me help. But iske ulta, if he has come to me and offer me umbrella and which I purchased for suppose 200 rupees, then it is recognized as transaction. So as per money measurement concept, a transaction or event, they always need to be measured in terms of money. The non-monetary or the transaction where money is not involved, they are not recorded in accounting. For example, if I do an innovative experience, but the experience was not commercial, till the experience is not commercial, it is not recorded in the books of accounts. For example, we made an experiment that two people, if I tie their legs, it will become them difficult for running. Now, this is an experiment. Where is money? There is no transaction. Since there is no transaction, it is not recorded in accounts. I went to the lottery shop, I purchased a ticket, and I won the lottery. Now, in this case, when I go to shop, I purchase the lottery ticket by paying some cost. It is called expenses because money is involved. If I win the lottery, again the money involved. But suppose after getting ticket, I feel joyful. that my joy is not counted as expenses because my joy, my attitude, my happiness, my passion, or my likes and dislikes, these are not encashed in money or kind of money. And that's why the transactions which are not valued or not able to recognize in terms of money, they are not recorded in the books of accounts. Now, one more thing about transaction concept is, for example, I have 10 kg of rice and one person has 5 liter petrol. So we decided to give the petrol. Vishal, either you continue or I'll continue. In the morning also you got a disturbance. Don't do that. So he will give me 5 liters of petrol, and what I'll do is I will give him 10 kg of rice, suppose. So 5 liter petrol currently, suppose we take 100. So he is exchanging with me 500 rupees. Now I give him the rice, and suppose it's very good quality rice, it is 70 rupees per kg. So how much I give it? So I pay him 700 rupees and he return me 500 rupees. So what is my profit? In this case, 700 rupees I am giving and 500 rupees I am receiving. So my loss is 200 rupees. Now this 200 loss I can record if I mention the both transactions in terms of money. But if I do not have the data about price per kg, then exchanging petrol and getting a rice, it's merely an non-accounting transaction because I'm not knowing their value. The accounting concept, money measurement, talks about only money or kind of money. If I value the transactions, I can get a proper cost. Secondly, if I'm able to value the transactions in money, then only I can record in books of accounts. I just take 10 rupees tea and it feel me energized. So I work for 8 hours. So that tea is costing 10 rupees. That doesn't means 10 rupees is my salary. So something contributing where output is not directly recorded or it is not evaluated in kind of money, then these all transactions are ignored in terms of accounts. So we have covered the another accounting concept, that is money measurement concept. And as per this concept, the things should be valued in terms of money. And if only the things are valued in terms of money, they are recorded in the books of accounts. If they are not in terms of money, I simply can ignore these transactions, considering these transactions as general and they are not relevant for account posting. Let's move on to the other concept. This is a very crucial concept in accounts, that is accounting period concept. In accounts, when I writing the books of accounts, it should be a period of 12 months, starting from a particular day and ending at a particular day. If I do not follow the periodic concept, then my data may be of 6 months, sometime maybe of 8 months, sometime maybe of 15 months, and sometime maybe of 2 years or more. So in short, the accounting period concept helped me to calculate my gain, understand my expenses, understand my income, and plan for future. So the accounting period concept is the concept which defines what is a period for which I am maintaining the accounts. If you remember in last semester when we used to prepare final accounts, I was always insisting to write in the books of XYZ for the period of so and so, or for the period of starting from this to this. Because when I will define the period, I will define the duration, I can easily evaluate and compare the performances. Also, I can check the frauds and errors based on the periods. So, as per the period concept, the financial performance are evaluated periodically to undertake the convenient comparison, to facilitate the convenient process to get and better exact results about financial performance. I need to see that it is classified into period which is normally in accounts from 1st April to 31st March, and this journey of 12 months is called a financial year. This financial year close on each 31st March, and then books of accounts are settled by 30th June, and all companies are required to pay the tax by 30th September. So, as per the accounting period concern, the business has 12 months duration. Now, we're going to discuss further, but let me go with two concepts. One is capital, and the second is revenue, and one more, deferred revenue or deferred capital. Now, when my period is from 1 to 12 months, starting from any date, it is called as revenue. But if it is more than 15 months and so on, it is called as a capital. Whereas from 12 months till 18 months, the accounting period is called as deferred revenue or deferred capital expenses. Now, what is defer? Defer means differential. Defer means additional. So 1 to 12 is an accounting period. 1 to 12 is a called as a financial period for which I am recording the transactions. And if due to some reason I need to extend the period, it is allowed up to 18 months, which is called deferred revenue or deferred expenses as per the applications. Now, very crucial, the cost concept. So we have first covered entity concept, the businessman and the business, they are two separate. Then we talk about money measurement concept, that everything should be evaluated and valued in terms of money. Then we talk about period concept, where we discuss the period of 12 months is considered as financial year, and it is considered as benchmark for understanding the performance, evaluating the output, and comparing what are the things which are crucial and essential for further progression or advantage. So for any doubt, please post in chat box or you can unmute. I'm just waiting for 1 minute. I think there's no doubts. So let's continue. The cost concept talks about what is the cost of particular thing. The assets which are acquired and recorded in the books of accounts They are always recorded as historical cost. When we record any transactions, they are recorded at lowest price, comparing the its purchase price or the basic price. Just read the slide. So as per this period, we have one more concept to understand, something called as historical cost. History is a journey. History is a journey which makes us learn what happened in the past and what is going to be effect in future. So if I purchase the asset in 1935, I may have purchased for 1 paisa, but now we are not having any value of 1 paisa. We want everything at 100 rupees or more. But when they are purchased in 1935 at 1 paisa, what is the value of money? It is considered, and I will calculate everything based on that value to understand the profit or loss in current financial years. So the assets are always valued as per their cost price and as per their market price, whichever is low. For example, when the Infosys started, the price of shares was 700 rupees. Now the price of Infosys shares sometime cross 3000. So if I want to record in the books of accounts, I can record 3000, but it unnecessary increase the number. And when the numbers are increasing, that may result in the profits. And when the profits are going more and more, I may require to pay the taxes, or the importance of valuation is ignored. Now, why I compared market price and cost price? Because whichever low, if I record, it will give me less profit, less liability, and more stability about business operations. So let's take an example. In 2010, I have cost of computer as 555, whereas market price is 250 in 2011. So at the foundation period, the price of these computers will remain same. But when I go to the market, I'll find out the historical price is high, but the market price is start declining. Why? Because that computer is not new. I have buy it from somebody and somebody was using it for their use purpose and the value declines. The best example is if I purchase a mobile and even I don't unpack it, but the mobile just come outside the shop or particular selling premises, the price of that mobile is reduced. Even the seal is there, even the packing is intact, but I need to consider the price has changed. So while writing the cost in the books of accounts, I need to first remember write the cost which is lowest by comparing the market price. Second thing, while recording the cost, I need to understand the additional cost. For example, when I'm bringing computer to my home, I require transportation, I require insurance, and I require installation. Unless these three things are completed, I am not able to use the computer. So these three things are again part of my total assets. Many times, as an businessman, to delight my customer, I'll provide him doorstep delivery, or I'll provide him service of taking the goods from shop and delivering to their native place or place of usefulness. So this cost is again part of my transaction. Sometimes when I shipping suppose milk, some bakery products which are perishable in nature, and I need to operate AC vans, then the cost of AC vans is also added to the product. So basically, historical costs are the prime cost where I had initiated the activity of business and I achieved the growth in tenure. As per cost concept, everything, every action should be accounted for money and related money effects. So far, any doubt? I'll wait for 1 minute. If doubt, just post in chat box. I think there's no doubt. So let's move further. As per dual aspect concept, it is dual and aspect. So it means that each transaction has two parts. One is positive and second is negative. So normally the positive talks about receipt of the goods or receipt of something. So when I receive something, it's a positive, and when it losing something, it's a negative. So again, it is classified in accounts as debit and credit. So as per this concept, each transaction is effected twice. For every debit, there is a credit. The transactions need to be recorded twice. Once I'll record as debit transactions, and second I record as credit transactions. For example, if I purchase the mobile of 1 lakh, then I need to think about what is debit and what is credit. The most common way, if I receive something, I'll mention it credit, and if I'm paying something, I mention as a credit. So in this case, I'm giving the mobile, I'm receiving the money or bank. So I'll write cash oblique bank account debit to the money which I supposed to receive, because here transactions are required to be effected one at debit side and at second at credit side. No single recording of any transaction is done. For example, cash sale is 10,000. Then what is the entry? If cash sale is 10,000, ultimately my entry will be cash account debit. So it is 10,000 to sales account 10,000. So if I compare here, even though cash sale is affected, it has two accounts. One is a cash and second is a sales. And considering this, I have to give two effects: cash account debit to sales account. So the two things are always involved as a transactions. Let's take example of one more times. Purchase from Ram goods worth rupees 20,000 and discount is received 2,000. Now in this case, I will pass the entry because I'm receiving the money and what I'm offering is payment for the goods which I'm receiving. But when I received the goods, he offered me discount of 2,000. Now, the discount is considered as business expenses, but in the hands of the person who enjoy the less amount payment, he is considered that gain. So here I am purchasing from Ram, but I am paying less. Instead of 20,000, I am paying actually 18,000. So 2,000 is considered as a gain. So I will pass the entry purchase account debit 20,000 to Ram's account 18,000 because he has only used 18,000 goods, and two discount received 2,000. Now why I required to match 2020? Because it's dual aspect concept, and I need to follow one more concept, that is matching concept. Please read the transactions and read the entry. I'll wait for 1 minute. Okay, I think it's done. There are no doubts. So move further. This concept of dual aspect period concept is result in the accounting equation. Now, what is accounting equation? Our asset side is equal to capital plus liability side. So, when I have the balance sheet, I will divide this balance sheet. Then again, I have three sides. So, as per this is my liability and this is my assets. So if my assets are 10 lakhs, then my liability, including capital, reserve and other thing, should be 10 lakh. If these two numbers, they are mismatched to each other, then it will consider as some error, either error of commission, error of omission, or error of confidentiality, that the things are parallel and equal to each other. So this concept denotes that for every asset, there is a liability and owner's capital block. Initially, we have discussed about money measurement concept and matching concept. As per these two concepts, everything is valued in terms of money. And so the next concept which is initiated is realization concept. Now, what is realization? Realization means again and again making repeated efforts to get connected. So, as per relation concept, every person or every entity who are dealing to each other, they will first understand whether the product they are dealing or service they are dealing, it's commercial or it is just a mere incidence that I got the things and I'm selling the things. So, as per this concept, the profit is earned when the goods and service are transferred. So, if you remember the legal aspects of business, void contract, valid contract. So, if there is a valid consideration in terms of money or kind of money, then all these transactions are recorded in the books of accounts when they are received or receivable. So, here I should either receive the physical possession, or I should receive the technical possession. Whichever the first and it identify commercialization, then I can record the value of that in books of accounts. Now let me share the story about realization concept. In realization concept, suppose okay, I'll change the color. In relation concept, we have again accounting period concept mismatch. If it is of period of 12 months, it's revenue income. If it is from 12 to 18, it is called deferred revenue. And those people who received the balance part in terms of profit or kind, they are being considered as valuing the products in a such a way that the customers are delighted and profit is indirectly or directly recorded. So 12 months it's a revenue, 12 to 18 months it's a deferred revenue, and when it is more than 18 months, that is almost 1.5 years, it is called deferred revenue. When deferred from 12 months but less than 18 months. So let's continue further. We will learn about dual aspect concern. So as per dual aspects, every debit has equal credit. Every expenses or every income or every transaction is recorded twice in the books of accounts. But matching concept denotes that whatever the transactions we are dealing with, they need to match for that period. What I recently shared, received or receivable, which is the first, I need to ensure to record at the first day. If it is up to 12 months, it is called a revenue. More than 12 months, it's deferred revenue. And more than 3 years, it will be considered as capital expenses. So the period concept and matching concept, they combinedly decides what is type of cost and how it should be recorded. If it is for 1 month to 12 months, the costs are normal, but they are recorded as a revenue cost and revenue expenses. Whereas from 12 to 15, it is considered as a deferred revenue income and deferred revenue expenditure. Whereas more than suppose 3 years period, that is 36 months, the transaction is happen, then it is recognized as capital. So based on duration, based on repetition, based on appearance, I can classify the transactions into revenue, deferred revenue, and regular revenue. So accounting period helps me to understand which is actually the accounting period, how much money I received or how much money I paid, with comparison how much money I am payable and how much money is receivable. So the matching concept always try to advocate that for every debit I need to write a credit. For every credit I need to have debit. That entries can be combined, that entries can be adjusted. For example, they have the two discounts, trade and cash. They can have multiple vendors, but ultimately they are going to settle at Satara or at Pune or at Mumbai or Nashik. The places are considered as periodic cost, and the data or the money, they are considered as accounting income. So basic role of matching concept is to match and find out the exact and the correct debit to the credit and credit to the debit. I'll wait for 2 minutes. Please go through the slide. I think no doubts. So let's move further. Let's understand this matching period concept. I need to pay the salary for 12 months. So from 1st April to 31st March, I'm always paying salary on 2nd of next month. But in April, the 2nd of next month will already start a new year in accounts. So for current year, if I want to make an expenses, my expenses should be oriented towards old eligible year rather than holding in new year with less interest. So, as per this, if the salary is not paid, it is outstanding. But if salaries are paid in advance, it is called as a prepaid salaries. In both the cases, the prepaid and outstanding, they are harmful, but complementary when we have supplied the goods, when we have paid the money, when we have purchased anything from vendor or online businessman, we need to pay the taxes. We need to pay something called as liability for transportation, octroi, and so on. So in all these cases, if I pay the expenses, it's regular. If I do not pay, then it become irregular. And irregular are further classified into deferred and capital expenditures, which is mounted and supported by various organizations which are working in that particular field. So far, we have covered the major accounting concept, going concern, entity, dual aspects, matching, and revenue. Please go through the slides. If any doubt, ask me. So there are 5 minutes. Let's recap the different accounting concepts. The first concept is accounting concepts and conventions is accounting concepts, sorry, is business entity. As per this concept, the business and the person, they are two separate people. The second concept is going concern, where the business is a continuous activity which never stops. The third concept is money measurement concept. Every transaction, every movement, and every shift of ownership, if it is valued in terms of money, then only record in accounts. Money is considered as common platform where I can compare the different prices and I can trade the non-monetary things also. Then we talk about accounting period concept where we elaborated our knowledge about revenue, capital and deferred revenue or deferred capital expenditures. As per accounting period concept, the every transaction, every process need to be channelized and recorded for 12 months. This 12 months is a certain period which I always require to declare at the start of my financial year because this will give me an idea from where to where my performance is required to measure and I can take better decisions, better accountability of my channelization depending on period. So as per period, there are three periods. One is capital, second is revenue, and third is deferred. When I make anything expenses, income or expenses for a longer period, it is called capital. For the period of 12 months to 18 months, it is considered as deferred, and from 1 to 12, it is considered as a revenue. So these all things are possible to remember by accounting period concept. Then we talk about the cost concept that whatever the cost, that is market price or cost price, we need to mention always the lowest one. While valuing the goods, we need to understand the historical pricing and their effect. When we record the cost, whichever is low, we need to mention that. In dual aspect concept, every debit has equal credit. It can be one transaction or two transactions. Only in case of banking transactions, I have a contra entry. Except this, the all transactions are regular. Then we talk about the dual aspect concept where we talk about assets equal to total of liability because every transaction is giving two similar effects, one at debit side and second at credit side. Then we talk about the realization concept. Realization concept says when you able to realize or recognize any activity in money or kind of money, it is considered as commercial and it is recorded in the books of account. A charity or mere act single side is not considered as expenses and not recorded in the books of accounts. Similarly, the next concept we talk about matching concept. As per matching concept, every debit has equal credit. So we completed accounting concepts. We are now going to learn about accounting conventions and full disclosure. So this is an essential and crucial part for university examinations. Now it's almost 7 p.m. Your next session is awaited. All of you can log out and join the next session. We can we'll again meet at 8 p.m. for my next session on international finance. Till that, you can continue learning and happy learning to all. Thank you. Now you can leave the session and join the next meeting.